Big talking point of the day was that first quarter GDP growth disappointing sharply, even against the market's bearish forecasts of around minus 1% quarter on quarter. We saw growth contracted by 2.2% quarter on quarter. Encouragingly, it did expand just a little by 0.8% year on year, but it's the largest quarter on quarter decline since the first quarter of 2009. Now, Michael Manamela, Chief Director for National Accounts, said this at the launch of the figures this morning.
Today, TSA has released the first quarter GDP for 2018, and in the first quarter, the economy declined by 2.2%. This obviously comes from a growth of 3.1% in the fourth quarter of 2017. There were basically key industries that driven the growth to the negative territory, and those were mainly manufacturing, mining, and agriculture. We saw that there was a big decline in manufacturing, which went down by 6.4%. And this is really influenced by declines we saw in petroleum industries and also basic iron and steel. Similarly, there was a decline in mining, down by 9.9%. And this is largely driven by declines we saw in production of platinum group metals, iron ore and gold. Now, when you look at both manufacturing and mining, they are industries that are largely export orientated. And we also then saw that there was a decline in exports of about 16.5%. Agriculture was down 24.2%. And this, you will recall that it largely comes from a high base we had in 2017, because in 2017, agriculture performed quite strongly. But of course, that is coming off a high base, and it was down now 24.2%. And particularly, we saw that there was a decline in field crops and horticultural products, and this relates to mainly your decline in production of wheat and also citrus fruits.
Well, I've got Citadel Chief Economist and Advisory Partner Maarten Ackerman in studio to help us on the one hand and on the other, I hope, Maarten, being an economist and an advisory partner, to use that well-worn expression. Good evening. How are you doing?
Good evening. Hi, Michael.
It's a big undershoot. The market wasn't expecting this particular number to come in even lower than the lowest expectations. What happened?
Yeah, I think, a couple of things. The year started off quite well, more from a confidence point of view, with the change in leadership. And I think that added to the disappointment. We did expect a negative quarter, and to be honest, you can't expect the changes that's been implemented so far to already have an impact on this quarter. So last year we started warning that the agricultural number is going to become a major headwind, because remember in 2016 we had a major drought, and then last year for the year agriculture expanded by 17%. So that was one of the biggest contributors to the growth we've seen last year.
Massive base effect.
The highest crop ever on record in the South African economy. So we knew that this year that will disappear. So that was almost expected, but it's still a big number, down 24% for the quarter. So I think if you add everything together, the fact that there's been also a bit of a soft start to the year globally, and we're a global economy, so we've seen the export number declining quite significantly, and yet in this period we actually saw a stronger rand, so that made us a little bit less competitive on the back of the positive changes taking place on the ground. So all of that together resulted in that 2.2, which is a bit of a shock. That puts a lot of pressure in terms of the potential growth for the rest of 2018, and also for anything like the fiscal targets that they've set in the budget. So if we don't get better growth for the rest of this year, we're probably back to facing a potential downgrade come October this year.
So things really do have to start improving from that second quarter, which, let's face it, if we look at the numbers, they're backward looking. Businesses take decisions as swiftly as they can, but it would have been very difficult to start taking decisions that would come through materially in these numbers based on what happened at an election at Nasrec in the middle of December. Let's have a look through some of the numbers now, and it's often put to me, I think by Dr. Adrian Saville, that our economy is investment fed and export led, talking about how we need to see gross fixed capital formation. We need to see businesses confident investing, not just on our markets, foreigners and locals, but investing in factories, building new capacity.
Yes,
Are we
yes.
seeing that coming through?
Not yet. So the growth fixed investment declined another 3% quarter on quarter. So that's a number that we want to fix, because if we can do that, like you say, we'll start creating jobs. Foreigners will be more willing to come and open new factories and shops and the likes. And it's not just foreigners, it's also local people. So I think for the past 5 years, we've been in a wait and see economy where even local business basically said, well, let's wait and see before we reinvest. So we need to change that, and it's early days, but the rebound in business confidence, that's the starting point. You first need to rebuild trust and confidence, have the right policies in place, and then it will follow. But I do think we need to taper our expectations, because everything that's being put in place and is continuing currently in terms of what the government is doing, that might take months, if not years, to actually fix some of the structural issues. So yes, that number was still quite disappointing in the first quarter. And then altogether, we still struggle with very unbalanced growth. So if you look at what I call the growth engine of the economy, where we need to create jobs for the current skill base, that's mining, manufacturing, is not happening there. And then you had some very good growth, the biggest contributor for the quarter in the government side, which, if you think about it, that's on the basis of more public employment. And
well, we're trying to convince the ratings agencies that we're going to keep the ballooning public sector wage bill under control.
So this number, from a ratings point of view, just highlighted that, yes, we've avoided it, thankfully, earlier this year, and that was probably because of all the changes that President Ramaphosa proposed. But on this trend, we're definitely not out of the woods yet in terms of that. So we need to fix that. We need to get growth back onto the table, and we need to make sure that as a result of that, we can meet the fiscal targets that they've set in the February budget.
And the consumer here, I think the market has long maintained that the impetus for domestic growth is going to start rotating out of the primary sector towards the tertiary sector. And for me, one of the big disappointments came from the trade, catering and accommodation industry. That seems to suggest that household consumption is, or that momentum behind household consumption is yet to take hold.
Yes, if you look at the consumption side of the numbers that came out today, consumer expenditure was up 1.5%. So, we're still a consumer-based economy, so we want the consumer to be in a healthy space. But where they spend is quite different. So they don't spend on durable goods. So it's almost like day-to-day living, non-durables that they're keen to spend on. So you will also want to see that they get into a position where there's more durable spending, because that's an indication that you're confident that you will keep your job, you're confident that interest rates won't come up significantly, and therefore you're willing to spend on longer-term items. But having said all of that, a positive consumer expenditure number still shows that despite all the challenges, higher VAT, higher petrol price, it's a tough environment out there for consumers, that as long as consumers can keep their heads above water, remain a little bit resilient, the return of consumer confidence will be a major tailwind to actually support growth going into the rest of this year.
Exactly what Andrew Vincent was talking about when he looked at his essaying thesis to say the deleveraging story is a big one amongst households in South Africa. Private sector credit extension numbers haven't been strong. Seems to suggest that South African consumers have been paying down those credit cards and other debts. And if confidence does return, then we could see the fabled resilient South African consumer shopping till they drop again. I think in the main, the market and many out there were really holding out. Obviously, they were expecting a poor number, but for some tangible signs that this new dawn is actually going to see in a new day. Do you see those tangible signs in these numbers?
Unfortunately, not yet. So I think, our message to our clients at the moment is to say that we've definitely seen a rebound in confidence, consumer and business. But that's what I call the feel-good factor. That's not real. That's not on. You can't see anything on the bottom line yet. So if you look at things like, forget about mining and retail and manufacturing, but if you look at the Reserve Bank's leading indicator, you look at the PMI, all those numbers don't see the Cyril impact yet. So, but I still think it will come. If we stick to the game plan right now, we are doing the right things. That's why we avoided the downgrade. That's why confidence is back. And in time, things will take place. It's like changing the GPS on an oil tanker. Is one thing changing those GPS coordinates. it takes probably a day or two to actually turn that ship around. And I think that's where we're in South Africa right now. The first quarter print was probably a little bit of legacy still from the past 10 years of state capture corruption years, and the fact that we didn't benefit anything from the global recovery. So that's still spillover from that. And what's being put in place now, we need to give time, but it will feed through into economic growth. That's why I'm still positive that, maybe it will be tough to get to the 1.8 that most people expect for 2018, but in time we should see higher numbers this year and hopefully next year on the back of the policy changes that's being implemented.
The gorging, the likes that we've seen over the last 10 years at the trough of state capture is going to leave a pretty big hangover and quite a lot of indigestion that we've got to deal with. Maarten Ackerman, Citadel's chief economist and advisory partner, thanks so much for sharing your thoughts on that GDP horror show.